Working capital is the lifeblood of any business, and it is essential to have enough working capital to keep operations running smoothly. Banks and financial institutions offer various types of working capital limits to help businesses meet their short-term financial obligations. Here are some of the types of working capital limits offered by banks with examples. Cash credit. Cash credit is a type of working capital limit that provides a line of credit to businesses against their current assets, such as inventory or accounts receivable. The credit limit is usually based on the value of the assets. For example, if a business has inventory worth $100,000, it may be eligible for a cash credit limit of $70,000 to $80,000, depending on the bank's policy. Overdraft. Overdraft is a type of working capital limit that allows businesses to overdraw their current account up to a certain limit. The interest is charged on the overdrawn amount, and the limit is usually based on the creditworthiness of the business. For example, if a business has an overdraft limit of $50,000 and overdraws $30,000, it will have to pay interest on the overdrawn amount of $30,000. Letter of credit. A letter of credit, LC, is a type of working capital limit that is issued by a bank on behalf of the buyer, guaranteeing payment to the seller. The buyer pays the bank, and the bank pays the seller. Example: if a business in India imports goods from a supplier in China, Indian bank issue LC on behalf of the Indian business to the Chinese supplier, guaranteeing payment upon receipt of the goods. Bank guarantee. A bank guarantee is issued by a bank on behalf of a business, guaranteeing payment to the beneficiary if the business fails to fulfill its contractual obligations. For example, if a business is awarded a government contract, the government may require the business to provide a bank guarantee to ensure that it will fulfill its obligations under the contract. Bill discounting. Bill discounting is a type of working capital limit that allows businesses to sell their bills or invoices to a bank at a discounted rate. The bank pays the business the discounted value of the bill or invoice and collects the payment from the customer when it becomes due. For example, if a business sells goods to a customer on credit, it can discount the invoice with a bank to receive immediate cash flow. Factoring. Factoring is a type of working capital limit that allows businesses to sell their accounts receivable to a factoring company at a discounted rate. The factoring company then collects the payments from the customers and provides the business with immediate cash flow. For example, if a business has outstanding accounts receivable of $100,000, it can sell them to a factoring company for $90,000, receiving immediate cash flow. In conclusion, banks and financial institutions offer various types of working capital limits to help businesses manage their cash flow and meet their short-term financial obligations. By understanding the different types of working capital limits available, businesses can choose the one that best fits their needs and helps them achieve their financial goals.